Hello and welcome to Elanomics. This is unusual for us to do Elanomics on a Saturday, but we said we are not going to miss this opportunity this week because some very, very critical developments took place on the economic front this week. And Friday, there were some circumstances we could not do the show, so we are doing it on a Saturday. And I hope that is not too much of an inconvenience for our regular viewers. Earlier this week, the rupee, our currency, fell to its lifetime low, a record low of 77.01 to the US dollar. It closed Friday, as in it appreciated a little bit, and closed Friday at 76 rupees and 76 paise. But this year, the rupee has fallen 3.5% versus the US dollar. And out of that 3.5%, 3.2% has been since the Russia-Ukraine crisis began. So this has sort of set alarm bells ringing in some sections, and there is talk about should the rupee be allowed to fall? Should the RBI intervene and stop that depreciation? Do we need a strong currency, or should the rupee fall and find its own levels? Lots of questions. Very critical, important questions, also complex questions which only Professor Ila Patnaik can address. Hi, Ila. So, Ila, this whole depreciation of the rupee, first of all, can you explain to our viewers uh, the level, how the rupee is benchmarked to US dollar or other global currencies?
So you see, there are a few ways of doing it. One is just the nominal rate. The simplest way of benchmarking the rupee is to look at, suppose I was to say, what is the exchange rate of the rupee? The simplest way to do it would be to look at the rupee dollar rate. Okay. Now that is, one may say, just the nominal rate versus one currency. There's another, I'll just go through the different ways of, just for the purposes of those who are not familiar with this literature. The other way of looking at it is, why just look at the dollar? We pick a trade weighted index. So because the moves against the other currencies, when it moves against the dollar, everybody's moving against everybody else. So what is that? And that we could look at the nominal effective exchange rate. Now that would mean we could be looking at 6 countries or 36 countries, the various indices where we could be taking trade weights, and we say, okay, some combination of weights based on the importance for trade. And, so I'm just sticking to just the basics and not going into the details of each. But one could look at the NEER, the nominal effective exchange rate. One could also look at the value of an exchange rate or a currency in terms of its real exchange rate. Now, when you look at it in real terms, you typically take a reference point or a base year, and then you say that if that was 100, then what is the real exchange rate now? So I could just do that against the dollar, and I could say, okay, if in year such and such, we take it as 100, then what is the real exchange rate? What we would do then is to look at the trends of the movement of the rupee, the movement of the dollar, and take away the inflation rates or divide by the inflation rates in the two. And we'd say, okay, so that's the real rate. In real terms, the rupee can buy more, or in real terms, the rupee can buy less. That's pretty much so if I was to take rupees across to the US today, convert them into dollars and take them to the US, would I be able to buy less or more compared to, say, 5 years ago, if that is my base year? So that's the sense in which you look at the real rate. And the real effective exchange rate, similarly, maybe not just versus the dollar, but versus other, say, trade weighted currencies that one could look at. So those are the ways in which you look at the currency. And in the present context, we are really discussing the rupee dollar rate, because that is what has moved.
So why is the strength or weakness of a currency, in our case the rupee, important? Why does it trigger such strong feelings when the rupee falls. Oh my God, the rupee is falling. It's a weak currency. It's the worst performing currency in Asia this year so far. And all. I mean, why does it trigger those concerns and alarm?
So let's just look at what it means for the rupee to become either stronger or weaker. That means for the value of the exchange rate to change versus the dollar. So if the rupee were to weaken, your imports become more expensive. If the rupee were to weaken, then if you had borrowed in dollars, you will have to pay out more rupees. Alternatively, if you were an exporter, if the rupee was to be weaker, was to become weaker, then and let's say you were selling for the same number of dollars as earlier, then you would become happier because you will be able to earn more rupees. Similarly, if you had invested abroad or you had income coming from, let's say, your cousin sitting in the US, you would be getting more in terms of rupees. Now, really, these feelings change over time. There are times in the life of a country, and we witnessed those times earlier, in the early 2000s, when rupee appreciation was seen as a very bad thing. Why? Because we were trying to push exports and the exporter lobbies were very strong. And even a small appreciation of the rupee or the strengthening of the rupee would create a big furor in the media that, oh, now you're letting the rupee become so strong, and now China is more competitive than us, East Asia is more competitive than us, and we're going to lose our market share in the world. And that was, so 2001 to 2004, the RBI intervened heavily, buying up dollars and preventing rupee appreciation, even though that led to a huge increase in liquidity in the system. It tried to offset that by sterilizing its intervention and so on. And even later, all the way up till 2007, that was the concern. Now, I think with time, one, capital controls have been eased. So a lot more people are borrowing. We see that most big corporates, at least half the big corporates have dollar borrowings. So they become very, very concerned. A lot of people send their children abroad. So, we know from the most recent news about the children studying in medical schools in Ukraine, or in the US, Australia, Canada, UK, Europe, and all this is denominated in terms of dollars. So immediately, your costs are going to go up if the rupee weakens in this case. So now the concern with the rupee weakening is much, much more. And particularly in the light of the oil crisis and the oil price increase, there is this additional factor that oil will become more expensive with the weaker rupee. So now the sentiment against a weaker rupee is, people are very emotional about it, in contrast to the early 2000s, when it was almost a similar response to a stronger rupee.
So this whole Ukraine crisis, the war, the spiraling of oil prices touched $139 in the week that has just gone by. What is the connection between that and why does the rupee get pressured like this, Ila?
So India is a big oil importer. And when the value in dollar terms of oil goes up, so we would need to spend more dollars buying that oil. And so our demand for dollars goes up. And that puts a pressure on the rupee because you're exchanging rupees for dollars. Your demand for dollars is going up, so you get pressure on the rupee. I mean, that's putting it very simply. Basically, you would then need to, your current account deficit increases. People understand that there is going to be greater pressure, and so that is going to put pressure on the rupee.
So basically, there is a flight or a fear of flight of dollars, which is the reason the value of the rupee gets pressured. Is that a very simplistic?
Those are two separate issues. So, sorry. One issue is that we are an oil importer.
Mhm.
And because we are an oil importer, because the price of oil goes up, we need more dollars.
Mhm.
And so if our import earnings are the same, let's say we were earning $100, okay, 100, you can put as many 0,000 million billion after it, but you were through your exports, you were earning $100. And then let's say you had to buy 1 barrel of oil, and that was at 100. Then let's say the rupee was then a comfortable, say 75. Okay.
Mhm.
Now, if the price of oil goes up, let's say in our example, the price of oil goes up to 130. If my export earnings is still at 100, but for that same barrel of oil, which I need to consume because I continue to, the short-term elasticity of price elasticity of fuel is petroleum is very low. So I will still need a barrel of oil. I might need a few liters less, but for that barrel of oil, I now need to get $130. So it is $130 is my demand for dollars, and my what I have earned is 100. So in the demand supply in the forex market changes. So that's the reason why the oil price increase puts pressure on the rupee. Because the demand for dollars is more, the supply is less. Something whose demand is greater, price goes up, so the rupee weakens. Now, on the second issue, which you mentioned, which is the flight of dollars. Now, actually, that was happening even before the Ukraine war. So that was something that after the US Fed indicated that it was going to hike rates, you got this risk of phenomena where this was, you may call it flight to safety, which had already started, where and higher returns. So if the US go up at higher, so institutional capital had already started FII investment in India, exiting from India, and so there was a pressure on the rupee. So for emerging markets, we are seeing two phenomena. One is the fact that India is an oil importer. So what oil importers are more hit by the Ukraine crisis rather than oil exporters. In fact, oil exporters' currencies have appreciated. So say Brazil, those currencies have appreciated because they are oil exporters. And emerging markets as such, which had capital from institutional investors, they had already started seeing the pressure for coming from exit of foreign investors. And India is seeing both those. So those two separate forces, but India is seeing both of them.
There is this conventional belief, which you also mentioned, about exports becoming competitive and exporters benefiting from the depreciation of the rupee. But in your column published yesterday on ThePrint.in, which will be given in the notes of this telecast, you say that it's not so simple because it may not always translate into higher exports. Can you explain that?
Yeah, so the time horizon matters. You see, so let's just go into the complexity. First, let's just take the simple textbook example, which says that, if I was producing, say, a shirt at 100 rupees and 1 rupee was equal to $1, and I could sell that shirt for $1, then, that's the price I would price it at for my the person who's importing the shirt. Whereas if the rupee dollar rate fell such that it was 200 to $1, then I would be able to price that shirt at 50 cents. Okay. And so I would be more competitive. Of course, here we are assuming that our competitors, like say Vietnam or Bangladesh or Cambodia or other countries, were also trying to sell similar shirts to the US, don't also change their price. They also don't see currency weakness. So in that situation, we are assuming that only the Indian rupee weakens in that example. Okay,
Mhm.
so that's the typical textbook example, which says that exports will become more competitive. Now, of course, one thing is it's not true that other currencies are not moving. Most other currencies are moving. As I said, oil importers are moving, emerging economies are moving. So many other currencies are also moving. So it's not clear that India will be a clear gainer in this export competitive market. I think the second issue is a little more nuanced, and that issue is what is the time horizon in which we are looking at this phenomena. Now, suppose you think that, oh, this is a temporary movement of the currency. You may not reprice your exports because the currency may move back and then you are in trouble. So let's say it is just people trying to think, especially in times of great uncertainty and in times of war, when we don't know how long this thing is going to go on, people may actually not really move the prices that they have marked. Only when they do, and only when the competitors also, don't have an advantage like we do because of their currencies weakening, then we get an advantage. Sometimes it's also, there's a third factor, which is that how much advantage you have also depends on your input costs. So if you have imported inputs, they've obviously become more expensive. So don't think of only the full price of the product that you're importing. You also have to think of input prices. And then it could be that the value add that you do has become cheaper. But the question then is, how much is that? So I just want to say that it's a bit of a nuanced answer. It's not as simple as the textbook example that exports will become cheaper, though that's what would happen in the long run if you are the only one and if you're mainly producing by adding value domestically and not through imports.
So the last point and the big point about RBI, the challenge RBI faces, should it intervene? Should it allow the rupee to slide to its real level, whatever that real level is? Because everybody keeps asking, how do you determine the real level? What should the RBI do?
So you see, central banks always have to make this very difficult decision about whether to let the currency move when it is moving, when it is volatile, or to try to intervene and to try to prevent that movement. The first thing that determines what they do is the size of the foreign exchange market. So if you look at the euro dollar rate, the euro dollar rate perfectly floats. Nobody tries to step in and really, or nobody has been able to or tries to successfully step in and intervene and move the euro dollar. Why? Because the market is so big that if you were to try to do so, you'll just lose your reserves, or you'll buy up too much reserves. So when the market is very big, you pretty much leave the currency alone. But there are situations like ours when we have, in an emerging economy like ours, especially in India, because we have a lot of capital controls, this market is not that big, we're not that integrated into global currency markets, that we feel that we can manipulate the rupee. We can intervene and the central bank can manage the rupee. Now, there what happens is that if the intervention is asymmetric. If the rupee is strengthening, that means there are lots of dollars coming in and it's the demand for the rupee which is high, in contrast to what's happening now. But to understand the full scenario, if the rupee is strengthening, you just have to buy dollars, and you can buy almost infinite amounts of dollars. It will have liquidity implications, but you can manage those, and there are ways of managing those. But if you are losing dollars, which means if you start selling your reserves, so you start with, let's say, 600 billion. If it is 30, 40 billion, 50 billion, you'll be okay. But suppose you start losing, if the market becomes very big and you start losing, let's say 20 billion a day. Then what happens is very interesting, because the markets realize that at some point the central bank is going to stop and will let the rupee depreciate. So then it starts, the speculators start getting out of the market, out of the rupee before the rupee depreciates. Getting out of the rupee means that they sell dollars and they buy up those they sell rupees and buy up the dollars that the central bank is selling in forex markets. And so it actually becomes a self-fulfilling prophecy. So that's what a speculative attack on a currency is like. So you want to prevent that. And so central banks just do a little bit of intervention, and that is what we expect the RBI to do small amounts of intervention, not really to have the value of the rupee, but just to smoothen out uh, on a day-to-day basis.
We'll take a couple of questions, Ila. We have Shaurya Sanjeev. Shouldn't we be diversifying our reserves because the US keeps printing dollars, causing excessive inflation?
But we have diversified so much. I mean, now, I look back at the last 20 years, you look at the composition, and we've actually moved about 50% or so into the euro. And including some other currencies as well. It's not a transparent basket, the reserves basket, but once in a while you do find mentions of that. And we have diversified a lot.
Oh, okay. That's good.
Yeah, it's the right thing to do, and we have done so.
Yeah. Minhaj Ahmed Ansari, who's a member for the last 6 months. Hello, Minhaj. Thank you for being a loyal member of the print on YouTube. He says, just an inquisitive inquiry. How can Indian bond market reforms affect the appreciation or depreciation of the rupee?
So bond market reforms would basically mean that there are more people who will participate in the Indian bond market. Okay, so what do reforms do? The objective of bond market reforms is to make the bond market deep and liquid, which means a lot of people can participate, and when they participate, then the impact cost of the difference between if you were to buy and to sell, and if you were to if I was holding a 5-year bond, I would be able to sell buyers. Okay, so if I wanted to sell it, so that would be the objective of the reform, and that would be the impact of the reform. Now, let's say reforms happen, because he's not asking what are the reforms. I won't go into that, but simply that if you have the reforms, what does it do to the rupee? So let's say reforms happen. So if the reforms happen, and if they happen successfully, then you will be getting a more deep and liquid bond market. When you get a more deep and liquid bond market, what does it mean? You get more participants who also trade much more. So who trade actively. Among those participants are foreign participants. So foreign participants are able to go in and out of the bond market more easily. Now we know that once they are foreign participants, then they also come in and out of the currency market, unless they got a sum of money which they then are just going to invest in India, and that typically doesn't happen. Typically, when prices move, they are investing in in a number of currencies, in a number of fixed income assets, and then they move across currencies and across assets. So when they've chosen to invest in, say, the rupee government bonds, and suppose they feel that no, the prices of these bonds are going to go down, we want to exit, they will also be trading in currency markets. So then your currency market, the size of your currency market increases much more, right? So size means the daily trades that happen, that increases much more. When that happens, then it becomes far more difficult for a central bank to manipulate the exchange rate. So that's the impact. So if the central bank is very keen on manipulating the exchange rate, then it actually prevents bond market reforms. And that's one of the reasons why India still does not have an independent debt management office, because that would give us bond market reforms which are being prevented.
Aman Birtal, I hope I got that name correct. He's a new member. Hello, Aman. Welcome to the Print family. How does the depreciation of the rupee affect the stock market?
So suppose you think that the rupee, let me start with the expected depreciation. So actual depreciation happens. You think that, this is what the rupee is valued at, and you may choose to either stay, or if you think that you have to do profit booking, you may exit. But let's think about a more interesting question in this, if I may add the word expected depreciation. Okay. Now, if you expect the rupee to depreciate, what are you going to do with your Indian stocks? Let's say you don't expect the stock price to, share prices to move. You just expect the rupee to depreciate. And you're a foreigner. You will sell your Indian stocks and get out before it actually depreciates. When you sell your foreign stocks, when you sell your stocks, so let's say so shares held by all foreigners, just an extreme example to explain. Suppose they all start selling because they think the rupee is going to go to half its value. Okay, then, and they don't want to be hanging around here and making their losses, because they have to, their investors have invested in dollars and they have to give their returns in dollars. And let's say they exit, then you will see high selling pressure in stock markets as well. And that will give you a decline in stock prices as well. So that's the connection.
Raju S, who's been a member for 2 months, has a very, this is a question which is, I would say, I mean, it's a complex question, but let's try and answer it. If everyone in India moves to public transport, will it solve the problem of costly oil? And would such a measure affect demand in the automobile sector? I'm asking because we have to balance the rupee according to the effect on import and exports. But my first response to that is, how can everyone move to public transport? Where is that kind of public transport in India?
Yeah, so he's obviously assuming that we first build the infrastructure. Uh, I think that this is a, long term, this is the solution. And especially because unless we all have EVs, and those EVs get energy from solar, because we don't want them also to be using power that comes from thermal plants. Yeah. Right, even if we get EVs, because then you'll come to the next level of questions. So if private vehicles were all, even if private vehicles moved away, so I think he's jumping a bit, so I'm just going through the steps, that if private vehicles go from being petrol based to EVs, and those EVs, then we move all of our power consumption away from thermal to renewable. Okay, whether it's solar or hydro or nuclear or whatever, but to renewables. That journey is anyway, even without high price, something that one would desire, because it reduces your carbon emissions. In this case, yes, if the price of oil goes up, it could actually push us to move faster towards that destination. And it would perhaps, despite the short-term pain, we're just looking at the positive side. I mean, we've been talking about the difficulties of oil price increase and the difficulties it has for current consumers. But if prices of oil remain high for a long time, usually what happens is then you get a supply response from fracking, from oil producers who can just pump out more. But I'm just assuming that that doesn't happen, because that's the question. Then if the price of oil remains high for a long time, it does push you towards more renewable, more public transport, more electrical vehicles. It does push you in the direction of reduced carbon emissions.
Last two questions. This one is from Sankalp, who's also a member for the last 6 months. Do you think India can expect some respite from the US and be allowed to trade with Iran? That way we can buy oil with rupee instead of dollars.
Over to you. This question.
It's not so
handle international relations.
I think it's a hope that India will be allowed to buy oil from Iran, because the US itself has gone and started conversations with Venezuela, against whom they had imposed sanctions against the Maduro regime. So if the US can go and talk to Venezuela, there must be some room for India to be able to go and buy oil from Iran. If you cannot buy it from Russia, Russia is offering oil at deep discounts. But again, that's a very complicated arena for India to get into because of the war and the sanctions. So yeah, Iran is a possibility, but we don't know. It depends on how long this crisis lasts and the war stops, continues, and what happens to what OPEC does. How does OPEC respond? Last question from Abhimanyu Lal. Ma'am, what would be or what could be the possible loss if the rupee becomes a hard currency apart from textbook nuances?
Well, I actually think that I don't see so many losses. I see more gains, because the loss would be that it would be more volatile. Okay, when it becomes a what you're calling a hard currency, means you basically have capital account convertibility, or you allow foreigners to hold the rupee. I think people in Dubai will hold the rupee, people in Singapore will hold the rupee. I think there are foreigners across, there are people across the world who would like to hold Indian assets, because we have an economy that is, all said and done, one of the fastest growing economies in the world, and so on. So, there are many, many people across the world who would like to be invested in India. And in some ways, that would mean that we actually become a far stronger economy. Even if the value of the rupee goes up more, or goes up, goes down, becomes more volatile, that will be par for the course. But if we have people around the world investing in India, looking at our assets, traveling here, because very often trade and investment go together. Okay, both increase. So if we have a lot of that happening, I think, and today, don't think of trade just as trade in goods. It's also trade in services, and India has a lot to offer. There are many, many services that have a lot to offer. There's so many restrictions today that, if we were to get rid of those restrictions, I think the economy would do very well. So actually, I see the good more than the bad, the gain more than the loss.
Mhm. I think we'll wind up, but before we wind up, just one quick question from me, Ela. Do you see the rupee touching 80? Is that the real level?
Well, YP, if our exchange rate is, it moves, it always moves. Our inflation rate is higher than the US inflation rate. Then sooner or later, at some point of time, it will definitely turn 80.
Mhm.
If you had asked me a question of whether it would be 75 when we were standing at the rupee at 50, I would have said yes, sooner or later, the rupee will turn 75. So as long as your inflation rate is higher than the inflation rate of the US, then all that might happen is during this period, there might be ups and downs, but sooner or later, you are going to depreciate in nominal terms.
Thank you so much, Ela. That was a complete masterclass on the value of the rupee and the depreciation and appreciation of currencies. Hope you found it as useful and insightful as I did. Thank you for watching, and we will be back next week with another episode of Economics. Until then, stay safe and have a good weekend.